Good morning. This is Ken Long from Tortoise Capital with a coaching minute with a case study in the DAX. And what we're going to study here is a trade series through a couple different of the international sessions. So, what I want to notice at position one is the market opened at the blue line, established a swing low in the dragon. This opened at yesterday's close, so it was a continuous signal. At point two, I noticed that instead of failing back to the previous swing low, the dragon makes a higher low, and that creates a pocket at position two for a reasonable entry in the pocket. It breaks out of the Z3 pinch and moves up quickly to a reasonable level at which a 123 exit or a P1 exit or an RLXD exit cashes at 3. It makes a dragon belly low a couple times at 5. The first two yellow dots may have got you in as pocket re-entries off the original first successful trade from 2 to 3. No objection to that. You have to do that not later than 6 if you're going to be a pocket re-entry player when you see that the support level at 5 happens twice. At 6, you can still enter because instead of failing back to the double bottom, it continues to move higher. So that's actually a pocket entry, and it is an emerging dragon from the hump of the dragon that was formed at 3. So 6 is a reasonable entry. At 7, you probably have a 1, 2, 3 exit. Depending on the time of day or when the next session happens, an exit at 7 is reasonable. If you didn't enter in the first 3 yellow dots, you could also enter at the yellow dot on 7 going long with an exit at the red support level at 5. You would exit at the first red dot in the pocket at 8. In retrospect, you would see the red dot at 8 as the as an owl entry in the other direction. So that would be an owl exit on an entry at 7. The first red dot at 8 is a reasonable owl entry. The second red dot at 8 is a collapsing dragon, is a mandatory entry on the short side. Your target would be the support levels at the red lines 1 and 2. When those get violated, you know you're in for a wild ride, Mr. Toad, and you get a move down to 9 where you get a RL10 reversal, a pattern 1, and an exit not later than the green dot at 9. You might treat that also as an owl, but because the 30 doesn't really roll up to a few minutes later, I wouldn't gig you too hard on trying to front run that owl and believing that that was an exceptional move to the downside and you want to get on board. So I stop and reversal at 9 green doesn't bother me. If you did that, you would probably exit at the first yellow dot at 10. 10 could also be seen as a pocket entry on a continuation pattern of the downward collapse from 8 to 9. The first and the second, or the first yellow dot at 10 could be a pocket entry short with a stop above the dragon hump, which would pay off on the next leg downward. If you didn't take it at 10, you might take a long position at the second yellow at 10, believing that was a higher low in the dragon. That's close, and you're probably trying too hard. Even if you did, you exit at the red dot at 10. That is a continuation pattern in the pocket from the collapsing dragon from 8 to 9. That red dot at 10 is a mandatory re-entry in the pocket. You would probably scratch that trade on the first green at 11. 12 green is an owl all day long, forever and ever. Your target is back to the resistance levels at 1, 2, and 5. You get that resistance here. I should have marked that up as 12 and a half. Failure to fail there now says you're in the money. You might have considered a second position. You're certainly tightening up your stop. Your target now is resistance at the thick blue line at the emerging dragon hump of the dragon at 7 yellow and 13 blue. When it blasts right through there, you might consider a second position at 13 green. If you did, or if you didn't, then the exit at 14 red gives you a tremendous gain on Mr. Toad's Wild Ride, and the rest of the day is just continues. I am less concerned about trying to classify what kind of a day it is than trying to recognize specific patterns and look for those low risk entries and then ruthless risk management. And having, if you have a directional bias, look for pockets and owls. Try the extra trades in those pockets as I've suggested at yellow. But if you try all of those, then you will get the big moves from 2 to 3, from 8 to 9, and from 12 to and 13 possibly to 14. If you are taking all of those, you will get those three big trades, and they will certainly pay for all the uh, ones that don't follow through in between. If you try to be selective about which ones to take, you will miss some of those big ones. So trade at a smaller position size, maintain your emotional energy, be ruthless on your risk management, and keep trading. Spend less time trying to explain the market and more time trying to describe the market, frame trades, and raise your mental energy so that you can sustain yourself through a long session. Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.